Okay, welcome to today's webinar titled SMEs Battle for Cash, Obstacles and Opportunities within SME Lending. Thank you for joining and stay tuned to discover how payment providers working together with financial utilities can change the current landscape and add true value to their service propositions to merchants. My name is Melisande Mouwal and I'm the publisher of the Paypers, the Netherlands-based independent leading global source of news and analysis for professionals in payments, fintech, and commerce. I'm delighted to co-host and moderate this webinar with Banking Circle. Banking Circle is a global-scale financial utility underpinning the service propositions of a wide spectrum of financial institutions, allowing them to focus resources on the customer relationship. Before introducing today's speaker, I would like to start with some quick notes regarding housekeeping. The presentation will take 30 minutes and we will have approximately 10 to 15 minutes for a Q&A at the end of the webinar. You can ask questions at any time throughout the presentation by typing your questions in the webinar application. During the presentation, we will compile questions and I will ask them at the end of the webinar. So Banking Circle commissioned a survey of over 500 business leaders responsible for finance decisions to discover what battles SMEs have to fight every time they need additional financing. The research found that even when such a business does get its hands on the much needed loan, repayments are traditionally fixed and don't reflect the natural ebb and flow of healthy business cycles. So in today's webinar, we will talk about better solutions for merchants that can be offered by their payment service providers and acquirers. Today's speaker is Tom Longhurst. He is Sales Director at Banking Circle. Tom has over 10 years experience in banking and financial technology, having held senior positions in organizations such as World First, Equinity, and Global Reach Group. So I would like to give the floor to Tom, and Tom, if you could please go ahead.
Yeah, no problem. But hello everyone. Delighted to be here to talk to you about some of the observations we've made in this space, and B, some of the solutions we think are well positioned to help SMEs both in the UK and Europe. So look, I'm not going to start by introducing Banking Circle. I'd like to kick off with my experience of lending in the SME space and some of the challenges that businesses encounter in getting this finance. So, and this will make sense, I promise, in due course. This is one of my favourite restaurants where I live in Teddington, and indeed it's a place that my 18-month-old daughter loves going for her sort of, I suppose, healthy food. It would be healthy wraps. It's a bit of a local institution, and it's been around for a number of years now. I know the owners fairly well. One of the things that came up recently in discussions with the challenges they'd had with the refurb of the business and just how difficult it had made making themselves, I suppose, profitable in the long term because of the cost inherent in doing up to the place, new refrigeration units, new displays, but then also the repayments they had to make on that. So it's a critical and very key example of the kind of small businesses that really struggle to get the finance that they need to thrive and survive. Some other examples, these are again local to me. Gosier's Deli on the right, again had a revamp, and Teddington Sports is a brand new business. And there are so many of these small entities, SMEs in the UK, that are really struggling at the moment, particularly on the high street. And I think this is something that we see across the board in our experience, not just the UK, but Europe as well. And interestingly, these businesses make up approximately 90% of the UK economy and employ 2/3 of the UK's workforce, which I think is a fairly staggering number. And if you look at what they'll contribute to the UK economy by 2025, that's estimated to be about £241 billion. So that's just the UK. If you extrapolate that across Europe, those numbers are obviously vast. And for all these businesses, there is a consistent struggle between revenues and the cash they need to stay afloat, but also grow from where they are today into hopefully moving out of that SME category into the sort of larger corporate space. I'm not sure Sidra will ever get there, but hey. I'll let this sink in a little bit. This is a shocking statistic that we got out of the research we did in this space. Over half of businesses in the UK have been unable to access the cash they need in order to grow. I think it's a sad reflection of the banking environment, and it's also a bit of a byproduct of some issues still as overhang from or a hangover, sorry, from the 2008 credit crunch. And the reason they struggle, well, small business lending is, as I said, still dominated by tier one banks, typically high street banks. And apologies for the picture, but I was trying to find a way of showing inflexibility. These entities are typically using static data that they hold on their clients or on SMEs, which are very limited snapshots of a company's financial health or a small business's financial health. So they are always one step behind actually what a business is doing from a revenue perspective, and they're not getting the right data in to make accurate and good lending decisions. It also is incredibly costly for these banks to underwrite loans to small businesses, and as a result, they often shy away from offering these loans, both because they're scared of the risk, because the data they've got isn't good enough, but also because the cost inherent to them in providing these loans is such that it doesn't make it worthwhile for them to lend to them. And look, again, some of this is still risk aversion on the basis of the 2008 financial crisis. So what is it that unites us as Banking Circle, you as attendees on the webinar, and businesses such as Sidra? Well, essentially it's payments. This is the lifeblood of all of our businesses. It's what we help our clients provide. It's what you in turn provide to your merchants, and it's what merchants rely on to get their revenues, to drive their income, and to ensure that they stay afloat. And it's this payment data and this payment flow that, as I'll describe later, we tap into to allow you as our partners to lend to these SMEs and solve some of the problems that they encounter in getting this financing today. So a really quick piece on Banking Circle. Who are we? Well, we've been around about 5 years, live for about 3.5. We transacted about $80 billion last year and processed 12 million payments. We are primarily an infrastructure play for people in the payment space. So typically these are clients such as acquirers, PSPs, any regulated financial institutions that are in the payment space. We typically find that we are a good fit for in one way, shape or another. And what do we offer? Well, there are essentially, I suppose, 5 key pillars to the business, most of which hinges around our ability to issue accounts, both physical and virtual. And these are virtual IBANs, settlement accounts, payments, foreign exchange, and of course, what we're talking about today, which is lending. So, bringing it back to Sidra, these guys obviously aren't a client of Banking Circle. I don't think they ever will be. It's not really our client set. We're an infrastructure play for large regulated financial organisations. But interestingly, I think actually one of the attendees on this webinar, they are a client of yours. So there is obviously a link between them as a small business, you as a provider, and then us as an infrastructure play. It's a shame they're not a client. I'd quite like some of the discounts on the food, but it's your position as provider in this value chain, in the payments value chain, in combination with us that can actually help solve some of the problems they have in securing finance. Look, these aren't the only sectors that we're relevant to. It's not just small restaurants and retailers. We work across a number of different market segments. So travel and leisure, and you can see some of the examples of how we can be used there. Restaurants and cafes, we discussed, health and beauty, food and beverage, media and entertainment, fashion and apparel. And I'll be open, we're seeing that spiral into various other sectors such as travel for higher value lending. But that just gives you a flavour that, all these businesses, what is it that unites them again? Payments. All of these businesses are taking both point of sale, online payments, however they're taking those funds in. That is the key thing that keeps them going as a business. It keeps you there as their supplier, and it keeps us in the mix as well.
Okay, Tom, can I ask a question here? Do you lend to all industries? Are there any exemptions?
Look, I think short of There are some fairly obvious exemptions, which would be things like arms dealing, etc. But I think realistically for this product, the key one that we would encounter from clients would be gambling. But even then, how relevant is lending to gambling businesses? I'm not sure. This is our experience to date is that businesses in the service industry and anyone selling physical goods, this is incredibly relevant to.
Makes sense. Thank you.
Cool. So look, we've talked about how you as partner and we can collaborate to solve the problems for these businesses. I think what we should dive into is how physically this manifests itself as a product. And I'll give a really, really high level pitch on how this works. And then the next slide will show you a little bit more detail. I don't want to go blow by blow because that's something I'll hopefully pick up in subsequent conversations with you individually. But purely and simply, the acquired funds that a merchant has, so the settlements they get from the schemes to yourselves and then into their bank accounts with whoever they bank with, that is the lifeblood of the lending solution. So what would usually happen is funds would flow via, say you're an acquirer or PSP, you would settle to your merchant as normal. The slight step change here is that we as Banking Circle receive settlements from yourselves or direct from scheme if we're holding settlement accounts for you already. And we are doing some splits on the revenues to repay loans. So what we do in the first instance is we look at payment data for that underlying merchant. That is the key thing that we use in any lending decision to one of these small businesses. That makes up about 80% of the profiling we do on whether or not the client is able to take a loan. And how do we do that? Well, there's a couple of ways. The really clever way we can do it, where we work with an acquirer or PSP, because you are sat on payment data for all your underlying merchants, we can essentially pre-authorize loan decisions to your merchant base. And we do that by taking essentially only 5 pieces of information, which are currency, amounts, unique client ID, company type, and then we can layer on some additional criteria as well to increase the accuracy of the loan offer. But we take that information and we run it through some proprietary algorithms we have, and essentially that kicks out a lending decision. So you as a payments provider, because you sit on this data and you sit within the value chain, you are actually in a position to look at your merchant base, look at the data there, provide it to someone such as ourselves. We run it through the algorithm and we can give lending decisions to your entire merchant base in, I think it takes 45 seconds. We've got that down to from a data perspective. So that's incredibly compelling because you can essentially tell a client that they are already pre-authorized for a loan and they can take that loan same day. If you look at that compared to some of the banks and what that takes from a decision-making process, it's incredibly fast. But I'll come on to some of the advantages of that product later down the line. What we're then doing once we've received these funds from yourselves is we are essentially just doing a split. So let's say we have given a loan to an underlying merchant and there has been an agreement for a 5% repayment per settlement for that loan. All that happens is we receive in 100% of the value that they have acquired from their sales. We debit the 5% as repayment of fees, and that 95% flows straight through to the underlying merchant. So they are repaying the loan as they earn, rather than having to sit and repay to any fixed schedules that a bank might put on them. I hope that makes sense. That's a lot of information to take in there, but I think this slide here, which look, I'm not going to go blow by blow through, but I think if you look at it, gives a slightly more nuanced and in-depth view of that money flow. I think the interesting thing again here is with the attendees that are on the webinar, because you are not merchants yourselves, you are in that value chain, is that we can sit in between the merchant and indeed their need for cash. And before they even have to go and do any sort of applications or anything manual, we can actually give them these loan decisions up front. And I think that's a really interesting thing that I can come on to, how we can white label this service and bake it into your product.
Tom, do you mind if I interrupt?
Yeah.
What countries can you lend to?
So actually, from a country perspective, today we loan throughout most of Europe. So we're particularly strong in Ireland, the UK, Denmark, less so the Nordics because it's so well banked. So we can absolutely offer loans there, and throughout most of Western Europe, to be honest. And then from a new jurisdiction perspective, it's quite easy for us to roll out into new territories. We just do some legal analysis at our end and look at how we structure it, and it typically takes us no more than a couple of months to roll out into new territory.
Okay, and is there a maximum loan that you can offer?
There used to be. Since we've taken on some new funders into our SPV, which provides the capital for these loans. These are essentially uncapped now. The limitation is usually based on the size of the incoming credits that underlying merchant is getting. So what we would usually see is that there is a cap of between 2 and 3 times that merchant's yearly card income. Outside of that, obviously our risk becomes slightly higher, but being open, this is all just a pricing game based on risk. So, if there's client demand for it, we can look at it, but those are just the averages that we would usually see.
Okay, thanks.
Cool. And look, just from going back to how the client actually secures these loans, there's a really easy sign-up process that if they approach, separately from providing any data via you as partners, it typically takes no more than 10 minutes for a client to input some information. You can see on screen here, this is sort of the first slide, the first window they would see when making an application. End to end, it's 10 minutes, and they should get an instantaneous lending decision. The compelling piece here, of course, is that you as partner, as PSP, as acquirer, you sit on all this information already. So actually the data that we're asking for here on this page is typically superfluous. Provided we've got a data sharing agreement in with yourselves, we can take all this data via API or via a file upload and do all the pre-checks, pre-authorizations to the underlying merchant base, pre-authorize loans using the algorithm. And essentially all that a client might see is just a pop-up on the platform at your end, an email, or even we do it via snail mail as well with partners, where they can provide these lending decisions without the client really having to do anything other than tick a box and agree. And I think that's where this becomes pretty exciting. And look, one of the unforeseen interesting points with this product and what it's done in solving a problem for some of these merchants is actually just from a visibility standpoint. So we've actually seen with some of the legacy partners in this space that where they don't have online portals that their clients can log in to see transaction information and payment data, we actually provide a fully white labeled portal for them to not only look at their loans, but it also, of course, tracks their card income as well. So we've actually seen that some of the partners we've worked with on this, their merchants now use this for greater visibility on their cash flow, which was just not something we'd foreseen, but is a nice additional benefit in rolling something like this out. And look, here's a quick example of a white label we've done with a partner in the space, RMS. You may be familiar with them. They are an ISO, a large one, and this has been a really good success story for us and them, and indeed their clients in securing the funds that they need to sort of grow and sort of build on that nice virtuous cycle of putting more money through that value chain, which of course works for both us and the partner from a revenue perspective. And look, just circling back to the client need in this, what are they getting? An intuitive platform to sort of put information into a really quick loan decision. I think one of the things I hadn't mentioned is this is completely off balance sheet. So for those of you who are more familiar with the lending space, this sits completely off of their balance sheet. It doesn't breach any covenants with their existing banking partners. And the really key thing here is flexible repayment. This is the big win over a bank who puts in place arbitrary repayment schedules that can be quite punitive for small businesses. These repayments move with a business in their natural ebb and flow. I think a good example which I can use would be a Premiership rugby club we have on books. as you can probably imagine, their intake, their cash flow is pretty squeezed during the off season. They're not selling kits, they don't have any gate revenues. So for them to be repaying a loan during that time frame just isn't viable. So this is a great solution for them in that it moves with their business. They repay more when they can, they repay less when they can't. And it's a win-win for all parties.
Hey, and Tom, so what is the go live process for this solution?
So if it's a direct to merchant go live, so there's different ways that we offer the solution out. The really simple low touch version is just a full white label where the client, the underlying merchant, is asked to input their payment data. And that essentially, I think now we've got that down to a week, where we essentially white label the platform, sign up process, etc. And our partners can then market that solution as their own out to their client base. I think it's slightly more nuanced when we start building in integrations where we have, where we're exchanging payment data via an API or secure file transfer to pre-authorized lending decisions. But we are now in a position where, as integrated as you would want the solution, we would see that I think the longest it would take us is about 30 days for it goes to market. So we built this as an infrastructure play. That's exactly throughout our business. What we want to be is infrastructure. We don't want a direct relationship with the client. We want to empower our partners to better monetize, better help their client base. And I think the speed at which we can deploy this solution is a testament to that.
Okay.
Cool. And look, I want to touch on flexibility again. Apologies for the funky photo, but I think this is the key thing that runs throughout this presentation is that this solution is it's a quicker, easier way of securing financing for small businesses that is far more flexible for these companies, and it gives them a far greater likelihood of securing a loan than they would by going to a high street bank. And we've actually taken that flexibility one step further, and we've provided what we call an instant settlement solution. And this works across both marketplaces, but more importantly in the card scheme space. What we've experienced with some legacy acquirers is the inability to settle sort of T0, T1. And the likes of ADN and Co have sort of come in as new entrants to this market and gobbled up some market share on the basis of their ability to do things like settle T0, i.e. I've taken the payment, I want my money today. We're now in a position with partners to essentially provide incredibly short-term lending, so literally intraday lending, to bridge that gap and allow legacy providers that have done a great job for a long time for their merchant base, but have some legacy issues around tech and the financial arrangements they have. We now have an out-of-the-box solution to help them settle to their merchants T0. And the really good bit here is that it essentially helps stop those attrition rates. It lowers those attrition rates, helps them compete with these young upstarts coming into the market, and essentially providing a competitive edge to better compete with them. And as I said, this pre-settlement solution, and indeed the overarching cash advance lending solution, works for marketplace sellers as well. So if you recall from the flow we were going through, the way we inject ourselves into the value chain is to provide an account to receive settlement into from card scheme. It works exactly the same way for marketplaces. We receive funds in from the marketplace owing to the merchant. We debit the fees from the loan as soon as those funds come in, and we remit the remainder to the underlying merchant. Where we've seen some interesting use cases for this, and I don't know if any of you on here play in this space, but we do a fair bit of work in Asia now with payment institutions in China. They only settle in every 21 days from Amazon to Chinese merchants. We are now bridging that gap and allowing them to take funds as soon as they make a sale, rather than having to wait 21 days for that sale. So there's some really interesting niches that we can play in with this product. It is, however, still the same product. It's very flexible. So we've talked about a bit about the value chain, how it works, and some of the advantages for the client. I think I just want to really quickly say what this means for our partners in this space. And here are some top-line numbers. We typically see a 5 to 10% penetration rate on any given merchant base. So if you look at your overall merchant client set, you'll probably have a number in mind of what that looks like. From a revenue perspective, if we look at how commoditized the financials are in the payment space and how competitive it is, we're sort of fighting over cents on payments, and we're fighting over basis points on things like FX. In the lending space, you can typically expect as a partner to take between 2 to 3% of the loan value as a revenue stream. So it's a factor of 1,000 to 2,000 above the usual revenue streams that our partners would get with their typical product set. And I think the most important figure here is that 80% of these clients that take a loan come back for another loan. That's the loyalty piece. I wouldn't say it's the needle in the arm, because I think that would be unfair. We like to liken it more to sort of just a nice virtuous circle of, right, they're in your ecosystem, they have lending there, they have payments there, there is absolutely no reason for them to leave you as a business, because they are getting essentially a one-stop shop through their payments, through to their cash flow solving. And I think this is the bit that I'd like to really emphasize in a space where it's easy for clients to leave and move and it's very competitive. That 80% figure is a way to really bolster loyalty within a client base and make it more sticky. And that's just to reiterate, we work with about 50% of PSPs and acquirers in the UK and Europe. We see the downward pressure on revenues by it being a commoditized space, and this is a really good way of bolstering revenue streams, building loyalty, and essentially just allowing you to weather some of the competitive headwinds that you may be encountering. And if I just bring it back, look, just some real top-line bits about the solution. Loans can be multi-currency. So not only is it multi-jurisdictional without Europe, we can actually provide loans in any one of 24 currencies. It's a very low friction onboarding process. Even if it's just referral-based and a merchant is logging in separately, it's 10 minutes to get registered. And it's essentially an instantaneous lending decision. And all they need to do is take the account that we give them and then give that to the PSP or acquirer that they are settled by. And then we're up and running. For you as partners, potential partners, fully white labeled solution can be done via iframe. It can be done via API. Phone calls are answered in the name of the partner, so it keeps them within your ecosystem. It's, as I said, a substantial new revenue stream. It's completely off balance sheet for you as a partner. We have an SPV that lends into the platform so that this isn't hitting your balance sheet. Though, if you are cash positive as a business, you can deploy some of the shareholder funds you may have to essentially get a return for shareholders on that cash. Entirely up to you. As I said, we're infrastructure, so where the funds come from, we love to fund it via the SPV because it's good for us. But equally, if you have cash, you can use it. For me, the biggest thing here is increased customer loyalty. I think that's a critical thing for us in this space and what we see with our partners. And I think the thing to bring it back to is this is not a difficult go-live process. You don't have to reinvent the wheel. It can be very low touch at the start and we can build on integrations further down the line. But the longest it would take us to get this live for you and your client base is about 30 days. And I think, look, Melisande sent me this article recently, which I think really brings it home about the change in the lending space and who the biggest lenders are now in this market and who the growing lenders are in this market. And these are direct quotes from an article on CNBC that PayPal, Square, and Amazon are becoming the go-to options for small vendors. And why? Because they sit on this data, the data that you as our partners hold, the data that we have access to. I think it's a really compelling article if all of you would like to read it afterwards. And I think it points to the fact that you have a similar position in that value chain, and there's absolutely nothing stopping you as partners collaborating with people such as ourselves to offer this kind of solution to your underlying merchant base.
Interesting, Tom. If you look into, you mentioned PayPal and Amazon. What is the situation for European marketplaces? How is this, lending to the suppliers on the marketplace is adopted in Europe? What are the opportunities there?
Yeah, so I think our experience thus far is that in Europe, we're probably a little bit behind the US. Which look, I think presents as an opportunity for those of us on this webinar. The likes of PayPal, Square, and Amazon have typically been very US focused and very strong in that space, and they've had very compelling offerings there. And look, I think a lot of that's just due to that. That's the geography they've grown out of. Europe does pose a challenge because it's not a single regulatory and legal environment. So by its very nature, it's a bit more complex to get into. But look, that's the problem we've looked to solve. We're a good partner in this space to essentially we've paved the way with the legal issues and the regulatory environment to actually open up the European market for these kind of solutions. So as I would see it, are we behind the US in this? Yes, but that presents to us collectively is opportunity.
Okay, so big opportunity here. Thank you.
Yeah. And look, just as a final point, I'll be honest, I'm a new dad, so I just wanted to shoehorn a picture of my daughter in. But as I said, at the start with Sidra, it's a place I love going to. It's a real shame to hear the kind of challenges they encounter as a business. I don't want to be the death of the high street. It's a challenging place for SMEs, and we collectively here do have, it is a revenue opportunity. Yes, it is a way to grow our businesses, but I think there is actually a nice story to this, and that's that we really can solve a genuine problem that these businesses encounter on an ongoing basis.
Great. Tom, thank you so much for sharing your insights into how PSPs and acquirers can offer instant settlement and instant loans with flexible repayment options. And by doing this, PSPs and acquirers can offer value-added services, increase loyalty, as you mentioned, 80% comes back for a next loan, and realize substantial new revenue streams. I'm happy to start with the Q&A. We have some questions from the audience, but please feel free to send in more if you like, and we will get to as many as we have time for. One of the questions of the audience is, and you addressed it, but maybe you can elaborate a little bit more on this. How is the onboarding process of the merchant when he signs up for a loan? How does this onboarding process look like?
Yeah, really simple. I think I showed one of the slides where it showed the initial sort of startup of the application process. And I'll talk through the two models. One where they're just approaching independent of us being given data up front by the partner. And that is where they will essentially just be asked to supply payment data from their incumbent payment provider. When they load that data up, typically we ask for 6 months of data that allows us to give the greatest chance of giving you a loan decision. Once they've uploaded that data, then realistically it's some fairly simple, straightforward information like company name, website, director names and addresses. And then what we're doing is out the back end, there are some automated processes that go on checking things like company's house. It checks things like social scoring, people hitting the website, anything on things like Facebook. And actually it does even, and I know this sounds a bit big brothery, there's, I think, something like 300 separate pieces of data that we take on. And it's things like even reading down to where the director lives. It tracks the trend in house prices on their street. While that sounds scary, actually what that does is it allows us to give really good, accurate lending decisions, and it ups the likelihood of that SME getting a loan, purely because the data set we're using is far richer. Sign up to loan issuance, we really are talking potentially about sort of no more than a couple of hours. The registration process is 10 minutes. There's hopefully an instant lending decision if it's low risk, and then they just have to get the funds from us, which is again very fast. If we're working with a partner, the sign-up process could be as simple as you've been pre-approved for a loan. Would you like that loan? They tick a box that essentially just has some T's and C's, and then we fund that loan to them within 10 minutes. That's how quick it can be when we're working with a partner, and that's where it gets really interesting for everyone.
It's definitely quick. Hey, you mentioned, Tom, that there is no maximum set for the loans, but what is the average size of loans?
Yeah, so I think the averages, they've changed dramatically as we've grown. I think the average loan is sat at about around the 40K sterling mark, but we are doing loans now as large as 5-10 million and as small as 3,500. So that average has been moving quite rapidly, sort of up and down. But I think within that range, you can see the kind of loans we're able to offer. And that's for both the small end of the market and the much larger end of the mid-sized market.
Okay, and if you look at the average length of a loan, what as far as you can see now, based on your experience, what is the length?
So what we would usually see is sort of 8 to 12 months as the average length of a loan, and then after that 8 to 12 months, we see that 80% refresh rate. So what you essentially see is people almost treating it like a bit like an overdraft. So they are continuously renewing that loan because once they have it, I mean, it's the lifeblood of their business, right? That funding is their cash flow, and it is what is allowing them to continue buy stock, do refurbs, whatever it may be. So yeah, 8 to 12 months is what we see, but it can be anything up to 2 years.
Okay, talking about cost and revenue, what is the average cost of a loan for the merchants?
I think the way to look at this is probably from an APR perspective, or you could change it to call it a factor rate. So it'll be anything from a factor rate perspective of sort of 1.08 up to 1.32, which is an APR of 8 to 32%. This is
Sorry, Tom, can you repeat that?
Yeah, sorry. From an APR perspective, which is probably the easiest thing for everyone, it's a nice, easy way to go through it. Between 8%, typically at the lower end, though it does go lower than that, to be honest, where we have certain guarantees in place and where the client is at a certain size, up to anything near 32%. At that upper end, I know that can sound like a bit of a scary figure, but I think the thing to recall here is that this is disclosed to the client up front. They are fully aware of those repayments. We've taken a lot of data in to make sure that we think that is a level at which we can lend. And these are often one-offs where it's a particular cash flow issue they're looking to solve for things like a renovation or whatever it may be. So again, it's not, these are repayments that are repaid when the client can afford as well. These aren't arbitrary repayments that happen throughout the year. Okay.
And from the P2P acquirer perspective, what revenue can they expect?
So I think the key figure to come back to is that 2 to 3% of loan value. So if you look at the fact that we are essentially lending out multiples of their monthly card revenue, if you look at a client's card revenue and as a PSP or acquirer, look at what you actually make as a percentage of the volume throughput that you as a business put through. Those percentages are typically tiny. We're talking single basis points. We're talking point something %. We're now in a position where if you look at what we can offer from a revenue perspective, you're now up at 2 to 3% of essentially that monthly card volume throughput. So there is actually a really compelling revenue element to this. And I think the thing to remember as well is that this is essentially zero cost. So there is no cost to implementation. There is no balance sheet impact. You're not having to front up the cash to the loan, and there is zero risk or recourse to you as a partner. So this is a substantial soft revenue stream with no risk and no barrier to entry.
So who takes the risks, Tom? That's the last question.
So via our SPV, we essentially do. So there is a special purpose vehicle that has the likes of Allianz global investors putting cash in. And essentially the risk is backed out via that SPV. So the risk sits with the lender and then obviously by association with us. Our partners are more than welcome to take on the risk by providing some of the capital for the loan. But our experience to date would say that in most cases, they look to us to take that risk and back it out rather than them take it on themselves.
Okay, great, Tom. Thank you so much. You're so knowledgeable on this topic. So thank you so much for sharing your insights with us. I'm afraid we are at the end of our time, but we will send all of you a link to the webcast shortly, and we will get back to questions that we did not have time to include in this webinar. But I would like to thank the audience for joining us. And we wish you all a very good day, and we'll hope to see you next time in another webinar. Thank you.
Great. Thanks all. Bye.